Hey everybody, it's Mike Nelson of efficientlending.net. Thanks so much for taking time to stop by my blog or my YouTube channel. Always appreciative when people take time from their day to check out some of my online content. So topic of the day is going to be volume number 2 on finessing your mortgage. We're going to talk about fixed rate versus ARMs. And I think ARMs are getting a bit of a bad rap. I understand where it comes from based on the financial crash. But the products have changed, and they are really good products when used properly. But before we get there, just thought I'd share a little bit how our family and several other families in our neighborhood celebrate the 4th of July. One of the dads down the street does a seafood or a shrimp really boil on the 4th, and then sometimes we get treated later in the summer when crawfish in Colorado come into season to a crawfish boil. But I'll tell you what, it's got mushrooms and shrimp and corn and onions, lemons, spice pack. It is a great way to celebrate and bring in the 4th, and we all get excited to hang out at their house and eat food off the table and just really celebrate the 4th and be thankful for our veterans and service women and men. And of course, we always do some fireworks afterwards as well. So thought I'd share that with you. It is as good as it looks for sure. And with that, we'll move on to the topic at hand, finessing your mortgage and how you might use an ARM to get the most equity and leverage in your home in the shortest amount of time. All right. Finesse your mortgage. This is number 2, the second topic in the series. And I chose ARMs because I think they really are misunderstood right now in today's market. And I think they're really one of the great tools that borrowers can use to get equity as quickly as possible in their home. And that's what you want to do. You want to purchase your home as fast as you can with the least amount of interest expense. So it's a tool that I think in the right circumstances needs to be looked at. So let's do just a quick definition of what a hybrid adjustable ARM or adjustable rate mortgage is. The interest rate is fixed for a predetermined period of time. So you're in a 10-1 ARM, your interest rate is fixed for 10 years and then adjusts according to the specific ARM thereafter. So in a 10-1 ARM, it adjusts periodically every year. So it's adjusting every year after the first 10 years have expired. I see a lot of advertisements. I hear a lot of customers and agents talking about ARMs, and I never hear a discussion on caps, index, and margin. And I'll tell you, these are very important parts to doing the proper analysis on an ARM. So caps come in 3 numbers, like 525 is a very common set of caps. The first number is the initial adjustment, limit on the initial adjustment. So let's say you have a 10-1 ARM. In year 10, the maximum that loan can adjust is 5 percentage points. The second number, in this case the 2, is how much the loan can adjust in the subsequent periods. So in a 10-1 ARM, it would be 2% every year thereafter on the anniversary. And then the lifetime adjustment is how much it can adjust over the maximum of the loan. So the caps serve the purpose of reducing risk a bit on the loan because the borrower and really the bank both know what the maximum amount of adjustment in what certain periods are. So that's good for really all parties. The index is the financial index that the loan is based on. So in this case, it's LIBOR. This matters because these indexes vary with inflation, markets, things of that nature. And then you have the margin. And that's just the interest rate that's charged on top of the index. So let's say you have a 5% index. I'm making that up. That's very high. I'll use a better example. Let's say you have a 1% index and you have a 2% margin. Your interest rate would be 3%. All right. Let's give an example. A 10-1 ARM with 525 caps. So the first number of the 10 says this will be a loan. The payment is calculated in the first 10 years based on a 30-year amortization schedule. And that interest rate will be fixed for the first 10 years of the loan. The 1 just says it's going to adjust annually thereafter until the loan has been retired. And then, so payments for the first 10 years are fixed because the interest rate is fixed for that first 10 years. And then you look at the 525 caps. We just discussed this a minute ago. The first 5 is the maximum amount that loan can adjust after the 10-year period is expired. The 2 is the maximum amount it can adjust every year thereafter. And then you have the maximum lifetime over the course of the loan. The most important part is there is no prepayment penalty on a ARM if you get involved in one. The prepayment, if there were to be a prepayment penalty, and that's not really very common, I think it's an unacceptable amount of risk for the benefits you're getting on the 10-year fixed period for your interest rate, but using a 30-year amortization schedule to calculate your loan. So where does the finesse come in? Let's see if I can't shed some light on this. First and foremost, the vast majority of loans are retired in the first 8 years of their life. So, for example, the homeowner is moving, they're refinancing, they're doing something to that loan that fulfills the note, and then they're moving to another house or getting a different loan, something of that nature. The way a loan works is, let's say you have a 30-year fixed loan, you're going to spend between 65 and 75% of the interest in the first 15 years of that loan. So what happens in the first 10 years is you really don't acquire very much equity in the home, but you pay a lot of principal. And what happened in the financial crash is the rates kept coming down shortly after the financial crash. And so people every 8 to 10 years kept refinancing, but they didn't refinance to a shorter term. They refinanced back out to 30 years. The net effect is, the way interest works, you end up spending a heck of a lot more in interest than if you didn't refinance at all. Okay. The other part is, let's say on this 10-1 ARM, you are getting the benefit of a lower payment because of a 30-year amortization schedule, and you're typically getting a lower interest rate when you choose an ARM. So what does that do for you? Lower payments, but it also maximizes your opportunity to acquire and pay off the most equity in your home in the first 10 years. Why is that important, and why is that finesse? Well, let's say your financial situation changes in the first 10 years. And now you're considering moving, upgrading, possibly a vacation home, something of that nature. Well, think about it. You've maximized your opportunity of getting equity in your home, and that equity can be used as leverage. You can sell your home to create a down payment. You can do a cash out refinance and use that as a down payment on an investment home or rental property. A whole host of opportunities because you've acquired the most equity in that home in the first 10 years. So if you are the type of person or family that has a likelihood of moving or refinancing or retiring that loan in the first 10 years, seriously consider the ARM because it's going to net out the most amount of equity for you, and equity is leverage. Now, last, hey, look, these are not the right loans for everybody, Afi. It's a tool. You got to use the right tool for the right job. How long are you going to own your home for age and stage? If you really think this is the home that you're going to own, you're going to buy, you're never going to move, you really should seriously consider the fixed option instead. The other part that is the risk is that you are forcing a decision, in this case, in 10 years. You are either going to accept the adjustment periods, or you're going to refinance, or you're going to sell. And you're making that decision the day you fund your 10-1 ARM. For some people, that's not a big risk. For others, it is a huge risk. So you just have to decide what the right decision there is. Last but not least, and this might be my most important issue here, is can you sleep at night? Look, you can make the right financial decision to go with the ARM, but if that just makes you so nervous, the risk, and allows you, you can't sleep at night and it gives you worry, go with the fixed and just pay down a little extra each month, and you're still in a pretty good situation. So, hey, listen, I hope that helps. Hope that clarifies why ARMs can be in the finesse kind of world when you're considering mortgages. Just barely brushed this topic. There's a lot more to it. I love to connect with people, love to talk to people. Feel free to text, email, or call me anytime. Hey, I'm recording this over 4th of July weekend, so I hope you have a wonderful 4th of July. Big shout out to all our servicemen and women keeping us safe, and our veterans who have given us our freedom. Hope everybody has a great and safe weekend. Thanks again for your time on my blog. Can't tell you how much I appreciate it. Talk to you soon.